Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month nickel and zinc. LME 3-month nickel. A bit of movement this past week, but it seems to have shot its bolt, so to speak. As I noted last week, the market was on a closing basis making a build-up since mid-May of a congestion around 21,000. And I suspect the recent attempt higher is as a result of that. I've taken a look at this action since early May with some fresh eyes, and there are maybe one of two possibilities here. We could have a rounded bottom or a descending scallop bottom. My personal thoughts are that the rounded bottom idea looks weak, given the attempt higher at perhaps the hardest time. I was going to say the stupidest time, but I decided to demur, the hardest time to break through late last week when the upper tine in bright red, currently at 22,455, of the February to April bearish shift pitch hook was reinforced by the slowly declining short medium moving average, currently at 22,680. If the market chose this week to try higher, then I suspect it would have been an easier opportunity. Anyway, a more reasonable pattern to look at would be the action to be a descending scallop pattern, which looks like a ski jump in profile. And the market can choose to shoot higher or fall back to the congestion around the 21,000 zone. I suspect that may be where we might look right now. It also suggests that the 21,000 zone will see the market break lower, but let's see what it does in trying to get down there first. Whatever it may be, it looks like the upper tine was breached and seems to be in the process of being repaired right now. Below this congestion, around 29,000, we next have support a little distance. This is the congestion between 17,815 to 18,850, consisting of the August 2019 high at 18,850, the June 21 high at 18,110, the important July 22 low down at 18,230, and the October 2019 high at 17,815. We also obviously have the declining middle tine, currently at 19,820. Meanwhile, above the upper tine, we have arching down the medium moving average, currently at 23,995, which is seemingly running parallel with the upper tine before we have next the flatlining long moving average, currently at 24,770, and then the August 2011 high at 25,195, which capped the market in April and May. LME 3-month zinc. Last week, we saw the market start a small reactionary move higher that towards the end of last week pushed up through the upper bear channel and significant 2023 downtrend, currently at 2416, and highlighted in dark blue on my daily chart. This was very interesting. However, all the market managed to do was rise up to the next overhead small congestion at 2497, plus the lesser Fibonacci line at 2509, and then turn back down again last Friday, with a seemingly resounding combination of a bearish dark cloud cover pattern and bearish double. We didn't even see it rise to the next serious group of resistances, made up from the February 21 low at 2547, the declining short medium moving average currently at 2566, and the purple middle tine currently 2592 of the super important May to August 2022 bearish shift pitch hook. This week we've seen prices drop gently, but still lower, and we seem to be seeing the bear channel trying to repair itself right now. Thus, overall, the picture is not that much different from last week right now, with the market moving in part down within the dark blue, potentially soon to be repaired April to date bear channel, which in turn is moving down within the purple May to August 2022 bearish shift pitch hook. To add to this, I have over many weeks spoken a lot about the March 2020 to June 2022 ascending, expanding wedge pattern. This is way up off the top of my daily chart. I've given in the past some outlandish potential targets for such a long dated and wide pattern. The primary outlandish target of such a pattern was in the 2545 zone. This was achieved 4 weeks ago. I last week laid out the potential secondary target X1. This was far harder to reach target, and it would be quite a way lower, down in the 1345 zone. Well, this one is definitely one to put in the back of your diary and only look at occasionally. In In the meantime, a more immediate support below has been the October 2020 low at 22.82, which has been breached at the turn of May into June. But there is an argument that it barely had a second consecutive close below it. And we therefore might consider it breached rather than broken. This ties in with the penetration and breach 4 weeks ago of the lower bear channel line. It wasn't enough then to verify, and prices pulled away higher, much as they did in the opposite direction last week and earlier this week. 2 weeks ago, I asked a question, and one that is still open, as to whether the market moves against the bear channel were just a tickle, or perhaps the first of a number of attempts to break it. Last week, it did not look so, but now I'm minded to think perhaps this is the beginning of a number of attempts at both the upper and lower bear channel trend lines. And it might mean we are coming to the end of the lifespan of this bear channel, and the market may now be testing for a way out.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.